call ratio back spread. So what does that mean? That means I sell a call closer to the money and I buy multiple calls out of the money. So the structure looks like this, okay? So strike wise, let's say we do the 20, where are we now? 16.5. Let's do it to, let's say we did it in August, right? Something short dated. We did it in August, stocks trading at 16.5. So say we sold the 18s, bought the 20s behind it, right? Okay. So what is the problem with doing this in August? So you can see you don't spend any money for this trade, right? It's a credit. So you're getting $0.50 for the ones that you are selling. You're paying less than 20 cents for the ones that you are buying two of. So happy days, I spend no money and I've got effectively a call option type payoff if this thing goes to the moon, okay? Which is true because if you look, if it really did go to the moon and Mara say doubled, which it can, right? Mara went from 16.5 to 30, you would make loads of money, right? And you would have spent no premium to access that. To access that upside payout, you would have spent zero money, right? So it can look really, really attractive, okay? Why don't I like it in August? The reason I don't like it in August is if Mara rallies 20% and goes to 20, okay? And it does that over the next 2 weeks, then look what happens to your P&L. You're going to be sucked into that hole. You're going to lose money because the option you bought ends up being worthless because you went to it. You didn't go through it. The option you're short is the one that you went through. So the problem with these call ratio back spreads, you get this whole, this valley, this black hole of P&L, whatever you want to call it, where if the rally happens too slowly, you get sucked into that hole and you could lose quite a lot of money. Okay. Or you could lose, depends how wide your strikes are, right? But you could definitely lose money. So even though you spent no premium for the trade, doesn't mean you can't lose money. You can lose money if you get sucked into the hole. You're more likely to get sucked into the hole close to expiration, basically. Because if we did the same trade in September, right, this time we spend a little bit of premium, but look how this thing evolves, right? You're not actually going to get into that hole. Look at the P&L. You can go a month. You can go to the end of August and there's no hole yet, right? The hole comes later. The hole comes in September and that's where you lose the max amount down there. Yeah. So the idea with the back spreads is you never want to get sucked into the hole, right? You never want that decay to be eating you up, basically, right? So you need to pick something that's long dated enough that you're not going to get sucked into the hole. And then you can choose to roll the structure if you want to roll the structure at some point, basically. Maybe with a month left to expiry, you roll the structure. And then you have never experienced that hole. You experience a little bit of decay, but you've never got really killed on that P&L, basically. Okay. So similar structure, like it costs 125. So what we would probably do for something like October, if we go out to October, that buys quite a lot of time for the rally to kick off. A lot of people are thinking the rally actually happens in Q4. So maybe you even go out to November and maybe you say, I'm going to sell the 20s, which are, quite high deltas. I'm going to buy the 25s. And that cost me very little. That cost me 65 cents. And that might be a way of doing it, right? And then you get access to all this upside if this thing really wants to motor higher. And remember, if the vol goes bid, happy days, right? If you basically start to rip, this is November, and that actually captures the election as well. But I suppose the election does matter for crypto now because Trump is just so pro crypto. Actually, it might make sense to own November just because it captures the election, right? So that's another reason to own the vol, because if you're saying I'm long vol on this structure, I want to be long vol in a bucket that's going to hold well. And November's going to hold well because it contains the election event, right? So that's actually, come to think of it in real time, that's quite a good idea, yeah? So maybe you do call ratio back spreads in this. And like I said, if we were, let's say, starting to rip higher kind of sometime in late September, you can see the P&L hasn't really moved that much, right? You haven't lost, let's say we get up to 20 or something, you haven't really lost anything, very little. And then let's say the vol starts to catch a bid and goes up by 20 points, then you're actually going to make some money back, right? So you could have a scenario where crypto starts to catch a bid as Trump odds start to go up into October even, right? Let's say you get into October and people are thinking Trump's odds are rising. then the vol could go from like where it is now 100 to 150, and you have, you know, what happens is your time decay that you're supposed to be paying gets offset by the vol bid that you get basically on the upside, right? So I don't mind it, but I think you do it out to something like October, November time. But I like November because it captures the election. All right.
We had a question earlier in the chat about Carvana. So just wondering, seems like Vic is bullish on them. Wondering your take on it.
I never look at the stock, so I don't even know the ticker.
CVNA. CVNA.
CVNA. Yeah, this is one of these. Isn't this one of these meme stocks or something? Hang on. I'm just gonna put it in here. It's been having a good run, that's for sure. Maybe I should look at it. So obviously a big bottoming out process last year. But look at this stock. I mean, yeah, it's definitely a meme stock because look where it was. It got as high as 400 and then it went to 0. Went from 400. Okay, that's nuts. And now it's back to 140. Look, I don't know anything about this name really. It's not a name I track or follow. It's obviously bottomed out, had a bit of an uptrend since last summer. Looks like a super volatile name, super crazy name. Dropped from 130 to 117 and then has recovered it. I'm guessing you're bullish on it, right? This is the sort of name that you're probably not going to really mess with unless you are just thinking it goes back to the moon, right? And you're bullish on it. I mean, the fact that it went down to the bottom of the range and bounced so violently, it's probably not a great entry point to own it here. Probably wait for another dip. Seems to be carving out a range right now between 120 and 140, 150. And we are higher end of that range, I would say, right? I don't know what the options are like in there. Let's have a look. I think with these sort of names, you probably want to be a bit patient and kind of let it come, pick levels and let it kind of come to you. So call wall up at 145. So we're not a million miles away from that. Put walls at that bottom end, hedge walls at 120.